Good evening, everyone, and welcome to UTI Mutual Fund's Fixed Income Market Insight webinar. The past few weeks have been particularly eventful for fixed income markets. Domestically, investors have been evaluating the implications of RBI's recent policy measures, evolving liquidity conditions, and the outlook for inflation and growth. Globally, geopolitical developments, crude oil price volatility, and uncertainty around the path of interest rates continue to shape the market expectations. Against this backdrop, investors are assessing the implication for bond yields, liquidity conditions, and fixed income portfolio allocation in the months ahead. I am Sandeep Solanki, product specialist, and I am joined by Mr. Anurag Mittal, our head of fixed income, who will share his perspective on the evolving global and domestic macro environment and what it could mean for fixed income markets going forward. With that, let me hand it over to Mr. Anurag. Anurag, over to you.
Hi, good day, everyone, and thanks for joining on this session. We'll start with the global macro outlook and then we move on to the RBI policy and the main domestic considerations before moving on to the product recommendation. So starting with key global trends, if we look at the JP Morgan Global PMI, which represents the manufacturing and services PMI, and if we see the manufacturing PMI continues to do well. In fact, it showed its strongest reading in recent years, and it's largely a game of front loading for the last 12 months. So if you see last year at the time of tariff imposition by President Trump in April 25, there was a front loading of various manufactured goods because as producers tried to again front load the various items before those tariffs started to hit the US economy, and when the manufacturing sector started to do well. So if you see this blue line at a period close to May 25, June 25, that is when the activity started to pick up. It dipped a bit in the end of 25. But since again the beginning of the Iran war, the activity, especially in the manufacturing side, has really picked up because producers are now building that inventory to ensure that they are not affected by the Strait of Hormuz closure. Secondly, one of the components of PMI is also the prices paid by the various manufacturers. So as inflation has gotten hold, various components are getting pricier because the disruptions are much longer than expected. Now we are also seeing that effect playing out in the PMI, where it's largely a statistical impact where the prices of higher goods is affecting the PMI. So it's not just reflecting underlying activity. So underlying activity, no doubt, is stronger, better, but it also is a depiction of higher inflation readings because of the Iran. If you look at services, on the other hand, services has been falling, although they continue to, remains in the expansion zone, any number over 50 is expansion. So while they continue to be expansion, but overall it shows that it's moderating. On the right side chart, if you look at the economic activity surprise index, which represents activity compared to market expectations. So any upward sloping curve represents better than expected activity, and any downward sloping curve represents softer than expected activity. So if you look at US, the activity index continues to move, really driven by very strong AI-related spending, data center-related spending, and spending in hard infrastructure. But if you look at Europe, on the other hand, is looking weaker, and it's largely a reflection of higher energy prices, political uncertainty, and overall the difference between the spending on AI in a way which is happening between the US and Europe. And so let's see how it is affecting various commodity prices. So if you look at the Bloomberg Commodity Index, overall this year has been very strong for commodities, especially after the after the Strait of Hormuz closure and oil prices picked up. But last month the commodity index fell as oil prices fell, as there was a temporary truce between the US and Iran. So there was an expectation that there will be a final deal between the US, Israel, and Iran. And we saw oil prices falling from 105, 110 to 95. So there was a sharp fall in oil prices and corresponding derivatives as well. There was expectation of peace deal, and hence we saw decline in commodity prices. Also, on the other hand, dollar strengthened. So because US inflation started to pick up, and hence expectations of Fed rate hikes are now beginning to take hold, that resulted in stronger dollar compared to rest of the world. Because if you remember 2 3 months back, there was expectation that probably the European Central Bank, Bank of England, Bank of Japan, etc., will hike, but US may cut because of AI-led productivity gains. But because as the energy prices are affecting long-term inflation as well now, there is expectation that Fed may have to do some rate hikes. So that resulted in higher dollar prices as dollar continued to do well. It resulted in decline in key commodity prices of gold and silver, due to which we saw a fall in commodity index. So basically, commodity index, uh, was broad-based decline from oil, gold, and silver. If you look at food index, on the other hand, food index remains on the higher side. So while the YOY change is nowhere close to what we saw during the Russia-Ukraine war, but still it's on the uptrend, which reflects the higher energy prices and various supply side chain disruptions. So we talked about in the previous slide how inflation in the US is rising 2 months back. Probably 3 months back, there was the expectation that US would be able to cut interest rates as AI-led productivity gains will lead to lower inflation. But if you look at what's happening in the US, the headline inflation rose from 2.4% in January, which was close to the 2% level, to now 3.8. It's the fastest pace of increase since 2023. And if you look at the breakup of inflation, that's very, very interesting. So if you look at the blue line on the chart, which reflects the core CPI, that's quite stable. That is being maintained between 2.5 to 2.75. So it does not show any major demand side pressure on the economy. But if you look at the contribution of food and energy, which is the non-core inflation. If you look at till February, that food and energy was slightly negative, and that's gone from negative to straight away 1%. So that's the swing that we are seeing in inflation, that because of this higher food and energy prices, inflation has gone from 2.4 to 3.8. So probably central bank will be able to ignore some of the changes, but overall the changes are very, very stark. They're very material. So central bank beyond a point will not be able to ignore these numbers beyond a point. Also, that has resulted in change in the reaction function from the Fed. So if you look at the swaps pricing from the Fed, and this shows the Fed's policy path projections. And if you look at 27th of Feb till the blue line, that was quite stable. And if you look at the green line, right, it was showing a declining interest rate. So people were expecting Fed to cut interest rates at least by 50 to 75 basis. If you look at the yellow line, now, if you see from the current interest rate levels, now that is reflecting a 50 basis rate hike. So from a rate cut expectation from 27th of Feb, because as inflation has gone up, although inflation is largely driven by food and energy, but the difference is very high. So while if the food and energy prices would have gone up, but still inflation would have been probably below 3, then Fed could have been. But because of this kind of inflation, where inflation is almost close to 4%, the expectation is rightfully building that Fed will not be able to ignore this higher inflation for long, and Fed will have to probably hike interest rates to ensure that real rates are in reasonable territory and dollar also remains stable. So that's largely the comparison of sovereign 10-year yields across the world for the last month. So as you can see, yields rose for most of the major economies, whether you look at US, UK, look at Brazil, you look at Japan, etc. Most of these countries are seeing increase in bond yields. If you look at India, India probably saw flattish kind of bond yield, where it yield remained close to 7%. Broadly, again, like I said, there is two large issues. One is fiscal expansion, because a lot of governments are helping support the spending into data centers, AI expansion, etc., etc. Plus, there is higher energy cost, which is feeding into higher inflation. So while many of the countries may not support the consumer by keeping oil prices steady, but in many countries it's passed off. So that inflation expectation, the change in inflation is also leading to higher bond yields and higher term premium. Now coming to India, so we had the monetary policy where the monetary policy committee voted unanimously to keep the policy rate unchanged at 5 quarter. This was a very interesting policy because before the policy we had seen sharp depreciation of INR as well. So INR continued to remain wobbly and was one of the worst performers in Asia Pac. On the other hand, we also had pickup in inflation. So while RBI had given an expectation of 4.6% average inflation for FY27, it was widely expected that RBI may have to revise its target upwards because that inflation probably would have not been sustainable because of higher oil prices, weaker currency. We are likely to see higher inflation going forward. And that's what largely RBI did. So if you look at the RBI projections, they moved from 4.6% to 5.1% for FY27, and we expect probably inflation, if oil prices remain where they are today, probably inflation to get close to 5%. So overall, RBI projections are largely in line with market estimates. If you look at growth projection were lowered from 6.9 to 6.6%. If you look at on the liquidity side, RBI committed that it will maintain adequate liquidity. So from a policy perspective, largely the rates remain unchanged. The inflation estimates and growth estimates mark to market. But the biggest delta from the RBI policy for the bond market was not interest rates. It was the currency measures that RBI took in close to the 2013 style currency measures, which gave a stability to currency, gave stability to bond markets as well, and led to a rally on the yield curve. So what RBI did was, if you remember it, we have discussed in previous presentations also, in 2013, RBI announced various dispensation of FC in deposits, as well as some sharing on higher cost of ECB borrowings, which led to significant dollar inflows and stability in rupee. What they had done is largely similar to what they did in the previous time as well. If you could move on to the next slide. So broadly, what they did was they have announced, on the FX side that banks can raise FC in deposits, and RBI will bear the full hedging cost of 3 to 5 year FCNR. So how it really works is a foreign bank in any foreign country location can raise deposits from NRIs. It will in turn deploy it at the domestic bank. At the foreign bank level, the depositor will leverage it up. So rather than just $100 going to the foreign bank and $100 coming to India, what happens is the typical NRI depositor backed by the FD, they raise that leverage to 9 times, to even to 15, 20 times, as we saw in 2013. So what happens is when they raise the leverage, they borrow at a certain level, and these depositors are at a certain level. So they earn the spread on their leverage. So in a way, it's like a banking kind of transaction. And the typical IRR which these foreign investors get is 15 to 20% dollar return. So mind you, because RBI is doing the hedge, so the return that they are getting is the dollar return. So that's quite attractive compared to even looking at alternate dollar assets, because these are fixed return assets and these are backed by sovereign bonds, and hence these are relatively stable. The second thing which RBI did is RBI told the various corporates that they are, especially PSUs, that they are ready to bear half the cost of swaps. So basically, PSUs who want to borrow from abroad, want to bring the money here, but want to hedge, RBI will bear the half of the hedging cost. So that basically makes it more attractive. So just to give an example, today a 3-year PSU bond is trading around 730. If I were to look at a 3-year all-in hedge position where the hedging cost is at least half borne by RBI, that straight away becomes 7%. So there's a 40 to 50 basis kind of a gain to the corporate if they want to borrow in the near term. So that's largely they did on the FX funding route. If you look at the bond market route, last year they had removed the 15 and 30 year from the FAR securities. This time they included that any new security on the 15, 30, 40 will be a farm security. So that also they did that. If you look at the green bonds, now green bonds will also become part of FPI limits where they can buy green bonds across from 5 to 40 a year. So overall, a very positive budget from the whether you look at from the government or look at from RBI. And the third thing what the government did was very positive. It removed the capital gain and withholding tax on bonds. So right now, many FPIs did not used to come to India because they had this friction that they will have to pay tax on their bonds. They may be in a double tax treaty. They may not have to pay tax ultimately, but they were frustrated. So probably by removing these frictions and removing taxation, etc., RBI has opened the window. We minimum expect 30 to 50 billion of flows this year, which will keep liquidity easy and which will lead to strong demand for corporate bonds. We have the trade deficit number. So while we saw trade deficit improving from 27.1 billion to 20.7 billion in March, the trade deficit jumped again in April, where largely driven by very, very high imports. If you look at export data is improving, but it's nothing significantly good. But if you look at abroad import data, that has significantly deteriorated, and hence we are seeing this very high trade deficit. So what we are looking at is at about $27 billion. So that's also quite high if you look at now India as a large economy. If you look at liquidity is quite positive. What we had discussed was that because of these various FCNR and ECB measures, we should get about 5 to 6 lakh crores. So already liquidity is positive about 2 lakh crores. You add 6 lakh crores, so overall we are looking at an 8 lakh crores liquidity surplus for the next 6 to 12 months. So overall liquidity is expected to be quite positive, and that basically means that the short end of the yield curve should remain quite well bid. Of course, while there is positive liquidity, RBI also has to bring down its forward by almost $20 million, by April 27. So broadly, assuming liquidity, even if it leaks out by 2 lakh crores, even then liquidity is expected to remain positive well in the system. Credit deposit, again, credit growth continues quite well. That wedge between credit deposit widens, and hence we are seeing very low demand from banks for government bonds because they are earning much better yield and much better spreads on their loan book. So hence banks are focusing on managing their loan book, and hence we are seeing lower GSEC holding. This year we do expect that credit growth to stabilize because now interest rates are going up, credit costs are also going up. So probably this year we will see some stability in bond yields because banks will be focusing on maintaining a certain credit momentum, and hence to support that they will have to raise deposits. But because now FCNR deposits have been available to banks, probably the problem of deposits will not be very, very high. So if you look at the yield curve continues to remain steep. So if you see the green line, which reflects the end of May level, and if you compare the 3-year to 5-year, 10-year, or to compare to 10-year to 30-year, so if you look, you will see decent steepness on the yield curve, largely because of the demand-supply dynamics. So while the demand-supply dynamics have improved in the last 1 month, especially with this ECB guidelines, but overall, the demand-supply opportunity for Indian bonds remains quite weak because this year you are looking at a 11 lakh crores odd of central government. You are looking at a 10 lakh crores of state government borrowing. So a total 19 lakh crores borrowing. And if you look at previous trends, there is a shortfall of 2 to 2.5 lakh crores of government bonds demand this year. So, and given that RBI has now done FCNR and ECB funding, they will get liquidity from those measures. So last year, RBI was doing OMO because liquidity was tight and it was able to justify it. So this year, probably with surplus liquidity, it will be very difficult for RBI to justify these kind of OMO purchases. So given the issue in demand supply, we saw some steepness in the yield curve. If you look at credit movement and credit spreads, if you look at AAA levels, there was about a 10 basis move in the month of May. So 3-year AAA moved from 768 to 778. At the same time, if you look at 5-year as well, the 5-year moved from 764 to 779. So overall, while levels have come down in the month of June because of a slightly dovish RBI policy and those measures in the FCNR and NRI deposits, overall yields went up in the month of May. Uh, as liquidity remained tight and there was concern on what will happen to the INR spread. So broadly, from an outlook perspective, RBI is likely to remain in wait and watch mode because what RBI really said in the policy is that these inflationary pressures are largely due to one-off and supply side shocks. These may not be durable. RBI may have to see whether these supply side shocks become more permanent, more structural, and they impact long term inflation expectations. So, as long as they don't impact long term inflation expectations, RBI will probably ignore the current temporary spike in the inflation. So, what RBI is essentially telling the market that at least for the next 3 to 6 months, as long as inflation does not climb up over close to 6% and growth remains where it is, RBI is looking at a very gradual policy rate hike cycle. So probably they will wait for monsoon. So we also have possibility of El Nino during June to July. So probably RBI will also wait for the impact of monsoon, that what impacts it has on food inflation, what impact it has on other commodities and labor side inflation, and then probably it will be a better call for RBI to take rather than take a call slightly premature. So we think right now RBI wants some information on monsoon and how El Nino is affecting the various crop patterns. It also is looking for better geopolitical environment where US and Iran are able to kind of resolve the differences and probably oil prices come down and hence India is probably in that situation would be slightly better. But till that happens, there's the impact on growth could remain quite high. But from a monetary policy perspective, like I said, they will look through the first round effect, and then only if there's a second round impact in terms of wage pressure or other inflationary pressures, only then RBI will intervene. From a liquidity perspective, we do expect liquidity to remain easy. Like I said, 7 to 8 lakh crores of surplus liquidity. So probably RBI will not need to do anything on the liquidity part, especially on the OMO part. And if the OMO is not happening, then probably you are looking at a slightly better short-end movement. So overall, we think the front to middle end of the curve is quite attractive because you have stable policy rate, you are on a very aggressive rate hikes, you have easy liquidity where you are largely quite clear that what's the kind of liquidity will be having. But broadly, investors who are looking at a 3 month to 12-month horizon can look at UTI money market or global duration strategies. These strategies don't carry too much of duration risk and hence are quite appropriate for investors in such high mark-to-market volatility. Investors who have more than 12 months investment horizon can look at short-term fund or a corporate bond fund with limited risk appetite on the credit side. These are typically AAA oriented. So AAA oriented credit short-term fund or a corporate bond fund will give the investors decent approval plus opportunity to participate in capital gain also as and when the rate cycle turns. So, and of course, investors investing beyond 2 years, they can also consider investing in income arbitrage, which will give them decent yield curve plus overall stability in their portfolio compared to just buying equity. So that was largely from my side. I'm happy to take up questions.
Thank you, Anurag, for sharing the detailed insight. Let's jump to the question and answer. So the first question is that the RBI chose to look through the current oil-led inflation shock and maintain rates at 5.25% despite rising its inflation forecast and lowering its growth outlook. How should investors interpret this policy reaction function, and what does it tell us about the relative importance of growth versus inflation in the current cycle?
Right. So if you look at the RBI reaction function, we think investors should interpret RBI's reaction function to be in a wait and watch. That also means that RBI is not in a hurry to hike interest rates. RBI wants to assess the medium-term impact of this El Nino, how it really pans out, what's the impact on food prices, what's the impact on inflation, how El Nino, affects especially vegetable prices, because we see, remember a couple of years back when, there was unseasonal rainfall, it suddenly led to spike in vegetable prices and very, very high inflation. But more than El Nino, it wants to also assess the impact of West Asian conflict. There are news that probably the US and Iran are looking at resolving their differences. So hence, if there is an end of West Asia conflict, probably your inflation will anyways come down and RBI may not have to hike aggressively. Assuming a worst case scenario where the West Asia conflict continues, will RBI hike really to tame inflation or to look at growth? We think it will be a combination. So while inflation is at 5%, growth is at 6.5%, probably RBI will hike by 50 to 70 basis to ensure that they have sufficient margin in case there is a further disruption on either geopolitical side or on the weather related side in India. So from every perspective, we think RBI is doing the right things. It is going quite steadily. It is taking baby steps. For the last year, of course, they were cutting. This year, what they have done is they changed their policy language. Now they are looking at a neutral policy. Slowly, they may hike, but we should expect hikes at the fang end of the year. So probably 50 to 75 basis hike one can expect in this monetary policy cycle.
Right. Thank you. So the next question is from Mr. Amit Gupta. So he's keen to understand the debt market outlook for next 2 years, keeping in view the global yields and the point which you just alluded about rate hike possibility.
Right. So on the global outlook, on the interest rate outlook, see, it's a function of inflation largely and growth. 2 years is a very, very long time in today's context. But broadly, if I look at the two forces which are working, one is the force of inflation, which is working due to tight labor market and higher commodity prices, as especially US and China continue to invest very, very aggressively in artificial intelligence. It is leading to very, very strong metals and mining demand and higher prices. Then you have seasonal variation or El Nino patterns emerging in some parts of Asia, which could result in higher food inflation for at least next 1 to 2 years. At the same time, if you look at growth, and if you compare to most of the economies, whether it's the US or it's China or Japan, we discussed growth between US and European zone. But if you look at the growth between US, China, Japan, Australia, India example, growth is much better than market expectations. So if you look at the interest rate outlook, growth is doing better than market expectation. Inflation is also slightly higher than market expectation, but inflation is largely supply side led. And hence we do expect rate hikes to happen, but we don't expect aggressive rate hikes to happen because again, the central banks also understand that it's a supply side issue, it's not a demand side issue. So hence, a global outlook is that yes, rates will go up, but probably by half of what they went up in the previous policy cycle.
Thank you. So the next question is, the market appears comfortable with the fiscal trajectory despite the possibility of higher subsidy burdens from crude, lower excise collections and continued public capex commitments. What implications could the evolving fiscal outlook have for fixed income markets going forward?
So if you see the government various measures, the government has cut excise duty on petrol and diesel to ensure that there is not a substantial hike that the oil companies will have to do for customers. So that excise duty cut could result in a loss of 1.5 lakh crores due to lower duty prices. Then they have also increased or they have maintained fertilizer subsidy despite fertilizer prices going up. So broadly, we can look at a higher fertilizer subsidy of at least 1 lakh crores. So 1.5 lakh crores excise duty cut, you have 1 lakh crores fertilizer, subsidy. On top of that, you have 25,000 crores LPG subsidies. So you are looking at about a 2.5 to 3 lakh crores of kind of subsidy expenditure because of this war. But at the same time, we think government can do enough to cut expenses despite touching capex. So despite doing capex, they have some space to cut expenditure and maintain their fiscal deficit. We believe that the government may not be able to maintain fiscal deficit, so they may do still end up going towards their fiscal deficit target of 4.3. But I think from a borrowing perspective, if you look at the track record of this government, it's quite clear that they don't want to borrow in the very, very long run through GSEC. They're happy to borrow through equity. We're already seeing some noise of disinvestment. We're already seeing some other, IPOs lined up. So we think probably government will try to fund this issue with equity rather than through fixed income.
The next question is, the spread between 5-year and 10-year segment has compressed meaningfully. Now, does the current shape of the yield curve offer any compelling positioning opportunities for active fixed income investors?
Absolutely. So there, if you look at right now, the curve is flat. In fact, because of the changes in the FCNR and ECB. So while it was steep till end of May, but today, if you look at June, the curve is in a sense flat. At 5-year AAA PSU is about 740, 10 years about 7.5. If you compare to 3 months back, probably it has now shrunk by 30 to 35 basis points. So we think that at least going forward, these spreads should remain maintained. The bigger thing is because of ECB borrowing by PSU banks and PSU entities, they may not come in market. So the spread between 3 to 5-year corporate bonds and the 3 to 5-year GSEC will really come down because of lack of supply in the corporate bonds.
So the next question is, now, despite elevated geopolitical risks and the higher crude prices, the 10-year GSEC has remained close to 7% mark. Now, does this resilience suggest that much of the macro risk is already priced in, or do you see the scope for more meaningful move in the yields from here?
So we think if you look at the swap curve, already 75 to 100 basis of rate hike is already priced. So if the rate hikes were to come, probably it will not be a surprise to the market. But if you look at the government bonds, I think there is also a function of lack of supply right now, because if you remember, in first half, government bonds, were trading, I would say, slightly higher, and government had announced a 58% first half borrowing, which resulted into rally on the bond yields. So we think it's also a function of lower net borrowing in the first half. Probably in second half when borrowing picks up, because first half borrowing was quite muted in on the government bond side. Probably second half we despite rate hikes, while we do not expect RBI to hike more than 50 to 75 basis in the current cycle, we think that long end, despite rate hikes, would continue to underperform because of these supply issues, and probably the 10, 30, 20 year will underperform in the next 3 to 6 months, and more opportunity can be found in the 1 to 3 year space.
Sure. I'll take one last question. The Reserve Bank of India and government recently announced a series of measures to attract foreign capital, including tax incentives and expansion of fully accessible route. Now, do you see these measures materially altering demand-supply dynamics in the government bond market?
It's a good question. While we think it will definitely improve liquidity, I think the bigger change that the government has done, which could improve demand supply for government bonds, is the removal of withholding tax. So while they have, brought in these ECB and FCNR measures, they've also removed withholding tax on income tax on the interest income. So that will probably lead to higher demand for government bonds from foreign investors in the next 12 months. So unlike last year where they were selling, this year we do expect some better buying opportunity from for foreign investors because of total removal of taxation. So that's, I would say, is quite positive.
Thank you. So thank you, Anurag, for answering all the questions and sharing your insights. And audience, thank you for joining us today. We trust that the insights shared by Anurag have helped provide a clearer understanding of the current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today, and we look forward to welcoming you in our next event. Till then, stay safe and have a great day ahead. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.